Welcome to vTalkInsight, Market Drivers Daily for February 16th, 2026. AI-driven volatility is starting to break the old link between U.S. tech and global risk appetite, while defense, spending, and regional flows are quietly rewiring where capital feels safest. Let us start with how the AI story itself is evolving. Earlier this week, we highlighted AI as the organizing theme for growth. But markets now treat it less as a blanket tailwind and more as a source of disruption and dispersion. The core shift is from indiscriminate enthusiasm to selective exposure, as investors weigh robust AI capex and earnings against concerns over sustainability, regulation, and real economy fallout. That change in mindset is driving sharp swings in leadership across tech, cyclicals, and defensives. On the macro side, the AI build-out is still a powerful support for activity. Internal forecasts pointing to around 2.9% real and 5% nominal U.S. growth this year explicitly cite artificial intelligence and related capital spending as key tailwinds, alongside fiscal support. One leading AI platform has reportedly added about $4 billion in annual recurring revenue in just 6 weeks. And companies like Applied Materials and Arista are guiding to significantly stronger sales on the back of memory chips and AI computing demand. AI-focused semiconductor stocks, including names such as NVIDIA and Avago, are described as enjoying strong earnings upgrades and growth that looks compelling relative to current valuations. Set against that optimism are growing questions about the economics of the infrastructure build. Rising memory and chip costs, combined with electricity constraints in several U.S. states and even project halts in places like Germany, are starting to threaten the scalability of very large AI data center plans. Heavy guidance matters for equity perception. Amazon's share price has dropped roughly 18% as investors digest around $200 billion of planned capex tied to AI and automation, even though management retains the option to slow that spending if the expected efficiencies or revenues fail to materialize. These tensions between growth, input costs, and balance sheet flexibility are a key driver of the current volatility in AI-linked equities. Labor dynamics and regulation add another layer of uncertainty. AI-driven business models are putting pressure on labor-intensive companies, leading to job cuts and employers' reluctance to hire while they reassess future productivity needs. There is active debate about whether the Federal Reserve should lean toward faster rate cuts to cushion potential job losses from automation, linking monetary policy expectations directly to AI disruption risk. Meanwhile, fragmented state-level AI and data privacy rules in the U.S. are seen as a brake on innovation, with calls for swift federal standards to preserve competitiveness, even as China's higher AI adoption rates are helped by policies requiring reemployment of displaced workers. In equity markets, that mix of tailwinds and stress points is showing up as intense dispersion rather than a simple risk-off move. Over $500 billion in market value was erased from 10 mega-cap stocks in a single day, while Asian and European technology names leveraged to AI infrastructure, such as ASML and Capgemini, have held up better on strong demand signals. Investors are rotating away from high-valuation software and business models perceived as vulnerable to automation, toward real-world asset-heavy companies in areas like consumer staples and energy, and toward firms that could demonstrate margin gains from AI in logistics, customer service, or supply chains. Flows are also shifting from broad passive exposure to more active, granular exchange-traded funds, as market participants look to differentiate AI winners from losers instead of owning the entire theme. Geopolitics is the second major driver, and here the story is one of sustained rearmament and shifting alliances rather than a short-lived shock. The war in Ukraine has accelerated demand for advanced software, hardware, and munitions, as modern conflict has become more lethal and time-compressed. European countries have already committed more than 200 billion euros to supporting Ukraine, with a further 90 billion pledged, while Poland has pushed defense spending to 4.8% of GDP. NATO members are discussing lifting their targets toward 3.5% of GDP by 2035, which could equate to around 6.8 trillion euros of additional defense outlays over the next decade, if fully delivered. Lessons from Ukraine are accelerating interest in AI and digital capabilities across Western militaries. NATO and partners are moving faster to deploy AI-driven systems and intelligence, targeting, and logistics, as the proliferation of cheap drones and quickly manufactured munitions exposes gaps in traditional defenses. European defense companies report sustained demand for air defense systems, long-range strike missiles, and counter-drone technologies, with firms such as Kongsberg expanding systems like NASAMS to cover longer-range threats and building positions in small satellites for both commercial and military use. At the same time, clients insist on data sovereignty, often requiring sensitive information to stay on national infrastructure, which supports on-premises software models used by companies like Palantir and shapes how American tech partners can engage. Beyond Europe, strategic competition with China is the dominant long-term axis of geopolitical risk. China is extending its influence through infrastructure and digital investments across the global south and parts of Europe, while maintaining strategic ambiguity about U.S. intentions. U.S. policy documents continue to frame China as the primary competitor regardless of administration, and the focus has shifted to risk reduction rather than full decoupling, with efforts to rebuild domestic capacity in semiconductors, critical minerals, and medicines. Tensions are visible in markets. U.S. scrutiny of firms like Alibaba and BYD for alleged military links has triggered sharp sell-offs in Chinese tech stocks and could lead to tighter restrictions on U.S. investment, at a time when a potential conflict over Taiwan is estimated to carry a global economic cost of around $10 trillion, or close to 10% of world GDP. Energy is another channel where geopolitics interacts with markets. Sanctions have forced Russia to sell oil and gas at discounts, deplete reserves, and lose core export markets, which may increase pressure on its ability to sustain the war. At the same time, Venezuela is opening more acreage to companies such as Chevron and Repsol, with U.S. officials suggesting output could rise 30 to 40% in the first year if investment flows, even as the absence of security guarantees and unresolved nationalization disputes deter many Western firms. China's $10 to $20 billion exposure to Venezuelan oil for loans deals underlines how energy, credit risk, and great power rivalry are bound together. These moving pieces add to broader systemic risk, in which no major economy would be spared from the fallout of a large-scale conflict in key hotspots. Despite these strains, the picture is not unremittingly negative. U.S. foreign policy remains anchored in support for NATO and interventionism, even when rhetoric suggests a more transactional approach, and European engagement with China is widely viewed as tactical positioning rather than a decisive realignment. Multilateral institutions, such as the World Bank, have secured record recapitalization, showing that there is still appetite for cooperative solutions, while structural diversification away from U.S. treasuries and higher geopolitical uncertainty continue to underpin long-term demand for gold. The constraint is political capacity. Europe is reassessing its role and exploring ideas such as a continent-wide nuclear deterrent and rapid reaction forces, but fragmentation and domestic leadership challenges may slow execution, even as Nordic and other middle powers step into more prominent regional roles. How quickly these plans translate into actual contracts and capabilities will help determine which regions and sectors bear the geopolitical risk premium. The third major theme is market divergence, which has only intensified since the start of the year. Headline U.S. indices remain close to record highs, yet leadership has fractured and many of the most crowded trades are unwinding. Outside the U.S., emerging and Asian markets are significantly outperforming, helped by strength in AI supply chain firms in South Korea, Taiwan, and Japan, and by renewed interest in Latin America. Recent price action suggests that global equities are decoupling from U.S. index movements, with investors paying more attention to local fundamentals and valuation starting points. Inside equities, sector and style rotation is the dominant pattern. U.S. tech-heavy benchmarks have come under pressure, with the S&P 500 Nasdaq 100 giving back year-to-date gains and 10 megacap names losing over $500 billion in market value in a single day amid AI disruption fears. Yet this is not a uniform de-risking. Consumer staples have outperformed the broader market by about 16% year-to-date, a margin rarely seen outside years of double-digit index declines, and investors are rotating toward energy, industrials, and materials, especially where companies are adopting AI to improve operations. Within sectors, dispersion is stark, with Rivian rallying sharply even as legacy automakers face write-downs, L'Oreal sliding as Korean and Chinese beauty brands gain share, and logistics, trucking, and travel stocks selling off on fears of automation despite solid earnings in cases like Expedia. Volatility has picked up, but it is highly concentrated. Commentators describe conditions as manic, with roughly 30% of S&P 500 constituents sitting at 8-week highs, while 15% mark 8-week lows, even though the index itself is only about 2% off all-time peaks. AI-related headlines are amplifying this, triggering sector-wide moves after relatively minor company-specific news, particularly in software and logistics. However, there is little sign so far of contagion into credit or private markets. Corporate bond demand remains strong, exemplified by a well-received multi-tranche issue from a leading tech platform. Long-dated auctions in the U.S. and Japan have gone smoothly, and credit spreads stay relatively tight. For many asset allocators, the practical message is that dispersion is once again being rewarded. Investors are gradually reallocating from U.S. equities toward international markets after years of U.S. and large-cap dominance. And within equities, there's a visible rotation from software and high-growth segments into small and mid-caps, value sectors, and companies with tangible assets that look less exposed to AI disruption. At the same time, valuations for leading AI and mega-cap tech stocks have become more attractive relative to the wider market after a period of flat performance. And historical analysis suggests that abrupt rotations out of high beta and momentum names have not reliably signaled poor forward returns for equities or emerging assets. That combination of cheaper leaders and stronger breadth is consistent with a cyclical broadening rather than the end of the cycle, particularly while global growth remains supported by AI and defense investment. Looking ahead, several signposts stand out. The behavior of AI, semiconductor ETFs, and sector indices will be critical, given their large weight in benchmarks and central role in the AI capex story. Sustained weakness there could turn what is now a rotation into something more systemic. On the other side, continued inflows into fixed income and defensive equities, such as staples and utilities, would point to a more entrenched risk-off stance, especially if equity volatility starts to leak into credit spreads. For now, markets are sending a nuanced message that aligns with recent days' narratives. Growth is holding up, but leadership is rotating, and cross-regional and cross-sector diversification is doing more work than directional market calls. To wrap up, AI remains a powerful engine for growth, but markets are moving beyond simple enthusiasm toward a more selective, sometimes brutal, sorting of winners and losers. At the same time, rising geopolitical tensions are hardening defense and technology blocks, lifting multi-year spending on security and pushing more capital towards safe havens. Under the surface, regional, sector, and asset class divergences are widening, with non-U.S. equities, real-world assets, and high-quality fixed income all playing a greater role in portfolio construction than headline indices alone would suggest. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.